back in the day, I was sitting in one of the ivory towers of one of the too big to fail banks, and I was watching it as it happened. I pretty much worked that whole weekend. And there's a serious misunderstanding out there of exactly what took place. This goes back to 1977, because in 1977, who was president? Jimmy Carter. And he came up with something called the Community Reinvestment Act. And the point of that act was basically the government said you need to make more loans to borrowers in areas that are low income, otherwise known as subprime. So then collateralized debt obligations were created by Salomon Brothers.
Hello, everyone, and welcome into CrushTheStreet.com. I'm here with a returning guest. Her name is TraderStef, and she has a 14-year career within the New York City investment banking industry. And she began investing in precious metals in 1999 while following the market trends post the dot-com bubble and 9/11. And today we're going to talk about the economy, gold, the history of what we're seeing, and just how that relates to what is going on now. So TraderStef is her name. TraderStef, thanks so much for joining me today.
Hey, how you doing? Thanks for having me back.
Hey, I'm doing well over in the East Coast there. I guess you're dealing with some cooler weather. I'm over here in Southern California. I hate to throw it in your face. It's kind of warm over here.
Hey, we had it pretty good here on the East Coast. Until about the end of December, but now we're getting the winter that we're supposed to have, so it's not.
Yeah, no, I know. We're supposed to get a lot more rain, and it's been rather dry for an El Nino year. If this is all that El Nino's got, I kind of think we're gonna be thirsty in the very near future. So let's get right into it. TraderStef, we have seen the worst start to 2016 for stock markets on history. This has been the worst. It hasn't been the worst year on record, but it's been the worst start. What have you been seeing in terms of your research regarding the general stock markets at the moment?
First, I want to mention, there's a misunderstanding, I believe, out there in the market with regards to what's causing the market's fall, and the meme and the financial media appears to be it's all China's fault. And I'm not really seeing that, because, once again, when you look at the data, for instance, the United States debt of the world comprises up about 29% of that debt. China's only like 6.25% of that debt. Japan is about 20%. So take that into consideration. And then you have the folks coming out in the mainstream media, most recently, like the former Federal Reserve President from Dallas, Richard Fisher, and he was on live TV, and he actually admitted that it's not China, that they're simply going through a transition from an export market to more of a domestic consumer market, and that the Fed juiced our markets, and the valuations are way too high in the equities, and we need to get back to some fundamentals. And, SocGen and Bank of America, they're all saying the same thing, that the market's been manipulated, and we just need to get back to some fundamentals. So with that in mind, if we're looking at the Dow weekly chart, I got these charts up to January 15th. It was last Friday's close. And when we're looking at the long-term weekly chart, you can see how it was rolling over, from about March of 2015, and it never really recovered. We kept hitting that upper downtrend line within the Fibonacci levels, but I want everyone to focus on the second part of the chart down, which is the DMI and the ADX. And I got those two little red arrows down there, and you can see it forms a certain pattern, because this is going to be a common denominator throughout the charts that you're going to see today. And, green is good, red is bad, and the ADX black line comes up like a tongue. And that is a strength of trend when it's going north. That tongue is going north. And you can see how it correlates with the price. As far as the price levels, I've got those all printed out there on the chart for everyone to see. But it looks like we're going to be breaking down. And we have a few more price levels to go through, short of some kind of financial event, which there's a lot to choose from lately. The Fed comes out and does a major stimulus package of some sort. What that may be, who knows? For what? And who knows?
TraderStef, what exactly is the black line showing us? What does that really mean for the trading for people who aren't technical traders?
Well, the ADX, there's a book that's available on this because it's a very deep, long-winded subject. But if one is interested, I would suggest that you go online and look up a book by Charles B. Schopp. That's Schaap. And it's called ADX Excellence, Power Trend Trading. So I don't want to get into all the nitty-gritty of how those numbers come up, but it's exactly what you're looking at on this Dow weekly chart of how it looks like that black line is coming up through the red and the green, and it creates a tongue. That's when you know you're getting into a very strong trend. If that black line is going down instead, it means whatever direction that the price is going in is weak. Just because it's going down doesn't mean that the price is going down. It's a trend indicator. But when you look at the red and the green line, which is the DMI, once they cross and the green's above and the red's below, that means price is going up. There's been a shift in the trend. And then it can continue and fall off. But the ADX combined with the DMI is giving you an overall view of what's happening. So if the price is going up and the ADX is falling, that's giving you a heads up that you may want to be paying attention because you could be rolling over for a short-term correction or a long-term correction, depending on what time frame you're looking at in the chart.
So it isn't something that just reflects the current market, but it actually gives you a trend forecast for what is to come.
Yes, it's basically the ADX works off of the DMI, and the DMI is an oscillator. And what it does, it measures downward price movement and compares it to the current period's high with the previous period's high. And the current period's low with the previous period's low. So it gets a little complicated, but it's basically compiling price movements and coming up with an average.
Okay. Well, I can definitely, it's very clear what's going on the charts, and comparing it to that big red candlestick, things do look a little shaky. So let's talk about gold. You sent me some other charts regarding gold. Maybe you can point out and kind of go over with us what the significance of this and what's going on with precious metals.
Absolutely. First thing I want to mention, the gold demand out of this Shanghai exchange was at a record high this year. It was huge. It ticked in at 3,500 2,596 tons. That's a lot of gold. Consider that the estimated global production worldwide is only 3,155 tons.
Yeah,
so
they're preparing. It seems like they're preparing for something big.
Yeah, the rest of the world has to divvy up the rest of that production. Now, that's not to say that the only gold available is what's coming out of the ground currently, but that just gives you an idea of what's available and what's happening, and it's being pulled out. So if we throw up the monthly chart of gold, which is as of January 15th, you notice I got that DMI ADX set up as a visual. It doesn't matter what you're trading, it's all the same. The DMI and the ADX applies to all. But we're in a price area that's, kind of weird. And when you're looking at the Fibonacci levels, which are those blue horizontal lines, we're in what I like to call a pigsty. It's kind of like a battle. And each one of those candles is a monthly price movement. We've been chopping along this in the low 1080s for a while. I mean, we went down below, we went a little bit above, but we're in this shallow falling wedge that started a little bit like mid-2013. That was the big fall.
Right.
So it's really important where we are right now that we hold this level, that we don't go any lower than we did, which I believe was 1046 and a few pennies, something like that. And then if we move over to the daily.
So real quick, TraderStef, can you just just kind of go over with us what exactly we're seeing with the ADX. Just kind of point out, I mean, again, this is new for a lot of us. What exactly are we seeing there and the significance of the ADX regarding the gold monthly?
Okay, well, it applies the same as we discussed with the Dow. So if you go back to shortly after the new year of 2001, we had the green line cross over the red, and then the black line, the ADX, came up from underneath, just like a tongue. And that's a very powerful trend because everything's going up. And then you can see how the price, it continued. It went on for years. That trend was never broken in the price, nor the DMI or the ADX. Now, there were some minor fluctuations in the price, particularly in 2008, which was really caused by margin calls. People went after their gold after the crash already happened. It started to go up initially, but then it fell. And you can see that right on the chart, how that took place. But notice right there in 2008, 2009, that ADX was rolling over, and that's telling you that the price is going down, but it's a weak trend. And the green line was staying above the red line. So we were still in a positive price movement overall as far as trend is concerned. And it wasn't until that overnight raid that started in 2013, just before tax day, that we actually got a cross on the red and green lines. And then shortly thereafter, a couple months later, that ADX came up from underneath and did the tongue. And there was a strength. But, you know, when you're looking at this, it's really this, no matter how far the price went down, you know, we're looking at $500, 5.5. It's actually weak. It's not a strong downtrend. So you can read into that what you like.
So what are you taking from this chart as far as what we are expecting? Because from what I'm seeing, we still got the red line above the green, and we do see the ADX coming back up. What does that mean for the future?
It means we're chopping right now, and we don't know what event is going to take place that would initiate something I like to call a ripo, which a rip your panties off move. I've hashtagged that on Twitter.
I Googled that term because I needed to know what that was, and you were the only one that had come up with it, and you were the top search for RYPO. Rip your panties off. Okay, so that's what we're looking at here for gold, huh?
That's what we're looking at. But I want to bring up something else about intraday trading, if I could.
Okay.
I also got a chart there for a gold scalp, and I gave two examples. I've got one from December 18th, 2015, and one from January 13th, 2016. But for the sake of keeping it short, I'm going to do the December 18th, and we can see how that DMI ADX plays into a intraday scalp. So for the traders out there who are turning over some fiat currency and want to trade in some profit for some real metal, well, this is how you do it on an intraday basis. You have to be watching it. You need to identify the trend. So looking at that December 18th chart, I've got some notes that I was mentioning on the Twitter feed. So you're getting it live on Twitter shortly before the moves actually happen. And there are always three waves in a move. Unless something comes up in the news which breaks the pattern when we're going into a third wave, it'll break down and it won't happen. But you're always looking for three waves, and your sweet spot, what you want to look for, is somewhere going into wave 2. In other words, you don't want to take the risk. You want low risk, high reward. So wait till wave 1 makes its case, and then you get a breakout from the high of wave 1, and that's your sweet spot. And then you have to decide where you're going to go when you get that slight pullback, and then you go into wave 3. And sometimes wave 3 can turn into a Momo play. It'll extend itself. It can even happen in the first or second wave. And by the way, this has nothing to do with Elliott wave.
Mm-hmm.
Not even close, but some folks see it that way. I don't. This is more about watching the ADX and the DMI action, plus the volume. And you'll notice that on this particular chart, how the volume was rising. And when we really got into that first wave, that was a lateral breakout from early in the morning, shortly after 7 o'clock in the morning. We retested it, and then shortly after the COMEX opened, a lot of buying started to come in. The volume picks up. We do a wave one. We chop out into a descending wedge. We break out, we go into wave two, and you can see how the DMI ADX is matching that. And that wave three, that's where you have to decide what you're going to do. Are you going to take your profits and run? You're going to be greedy? Stick to your plan. Make your trade, stick to your plan. Wave three was an extended wave. It was almost like a fake out. And then you can see where it breaks down. So there is a perfect three-wave example for an intraday trade.
And that's very clear and very evident that you've been able to do that. So I wanted to ask you, because you've done some analysis on the 2008 financial crisis, and The Big Short just came out, and that's been given a lot of people some ideas of what happened in 2008, what kind of happened in the financial crisis. So let's talk about history a little bit and get your thoughts on what we saw during the big bubble burst of 2008. And, let's talk about what's happening now with the same or different scenarios that we're seeing.
Back in the day, I was sitting in one of the ivory towers of one of the too big to fail banks, and I was watching it as it happened. I pretty much worked that whole weekend. And there's a serious misunderstanding out there of exactly what took place. And it's public information, and people who are following the market understand this. But general mainstream feeding information is just not accurate, and it had nothing to do with subprime mortgages. Now, with that said, this goes back to 1977. Because in 1977, who was president? Jimmy Carter. And he came up with something called the Community Reinvestment Act. And the point of that act was basically the government said you need to make more loans to borrowers in areas that are low income, otherwise known as subprime. So then collateralized debt obligations were created by Salomon Brothers, and I'll get more into what they are and what happened. But then Bill Clinton came around. In 1995, he revamped that CRA law. And the government was basically putting pressure on the banks. They had a requirement. I don't remember exactly what those percentages were, but they had to have so many loans out there, and then they had to do something with them. And then toward the end of his presidency, they also repealed Glass-Steagall. And I'm sure everyone's heard about that. Mm-hmm. And then Glass-Steagall was a banking act from 1933. And what that did, that kept the commercial banking industry separate from investment banking or brokerage houses. And once that was thrown away, there were some other specifics about that law that I don't want to get into. But it was no holds barred, because then we had 9/11, and then the major QE and money printing. Big problem. There was QE going on before officially QE was actually going on. So it wasn't, the Big Short doesn't necessarily talk about that. The Big Short talks about the actual trading that was going on behind the scenes and explains the collateralized debt obligations and the mortgage-backed securities and all those different acronyms they came up with for these packages of mortgages. Really great movie, but it doesn't touch on what exactly happened.
So let's talk about QE and it happening before it was officially happening. Where is the data for this, and can you expand on that a little more?
Yeah, it was known as Greenspan put.
Okay. Yeah.
I mean, we've got all kinds of federal laws out there that allow the government to intervene in the market.
Sure, yeah, and I mean, with record low interest rates, I mean, we know that they're going in and manipulating the market. I mean, supposedly they've been tapering, at least even now. Supposedly they've been tapering QE, but the Fed balance sheet is continuing to grow, and you have some data on this, actually.
Yeah, I got a chart there for you that shows you what the current as of the 13th of January this year. And it's really it's not necessarily growing, it's fluctuating a bit, but it's not shrinking. So there hasn't been any exit strategy. Because there is no strategy. And what they're doing, and Yellen has repeated this time and time again, and you can go back and you can find it in numerous minutes. And I'll read you one. She said, "We will also continue to roll over maturing Treasury securities and reinvest principal payments from the FOMC's holdings of agency debt and agency mortgage-backed securities and agency mortgage-backed securities." She said that twice. "These sizable and still increasing holdings will continue to put downward pressure on longer-term interest rates, support mortgage markets, and make financial conditions more accommodative, helping to support job creation and a return of inflation to the committee's objective, which currently is about 2%. So all they're doing right now as far as exit strategy and their increase in the interest rate of 0.25% really isn't doing much good, because I have another chart which is taken from the Treasury Department's website. And flattening the yield curve, when you look at those numbers and you go down the line, the 30-year Treasuries, they're pushing those rates down, and the shortest term, the 1 month, those rates are slightly going up. And the rates in the middle, like the 1, 2, 3, 5 years, they're all kind of flat. That's called flattening the yield curve.
TraderStef, when it comes to money printing, QE, that is inflationary because they're printing more money. But yet the velocity of money has been, at all-time record lows. The effect of the money printing hasn't been entering the economy because a lot of it has been sitting on banks' balance sheets, and we've seen the effects of inflation happen in the asset markets, or the asset classes such as real estate and stocks, which have helped the uber rich, the uber 1%, and the middle class who have owned real estate through the right time, at least. It's helped them as well. But do you see this being inflationary in the near term, or is it going to continue to not circulate the way it's been?
Well, it's not going out to Main Street. The whole point of bailing out, which are now going to be bail-ins, was bailing out the banking system. And now the banks keep their reserves on the Federal Reserve's balance sheet, and they're getting interest. They're getting interest on that money. So why do they don't really need to take a risk?
Right.
Which comes into reverse repos and flattening the yield curve. But the result of everything that happened in 2008, I want to mention another movie besides The Big Short. And it's kind of hard to find. It was produced by the BBC. It was called The Last Days of Lehman Brothers. And I can tell you there were certain scenes, even though it was a documentary / film, it was truly accurate. And one of the best scenes from that movie was in the very beginning, the first board meeting down at the New York Federal Reserve Bank. Timmy Geithner was there. Hank Paulson was there. Remember, Hank Paulson was the Treasury Secretary. And all the banking heads were there. And John Mack, who at the time was the CEO of Morgan Stanley, and John Paulson was trying to explain to them, what was going to... Hank Paulson was trying to explain what they were going to do. And John Mack just got up and walked out. He's like, oh, well, you're going to let Lehman Brothers be hung out to dry? Well, see ya. As he was walking out the door, Paulson stopped him by saying something. And this is what it was. And I can't speak the language in the interview because before that a word. He said, the West is foobar. We foobarred it. Oh, not just you and me, all of us, the West. It's done. It's over. You
Wow.
want to call it a game? This is the game. You want your great-grandchildren speaking Chinese? The dollar is going to go. We had Rome, then we had Europe, then this, us. This thing with cars and stereos and hula hoops, we screwed it all up. We ran through it all, this stuff. And we've come out on the other side where it's, I don't know, where is this place? Oh, yeah, we have this one weekend where maybe we can come up with something to hold it all together. Here's the money quote, for a little while longer.
Are they letting it go right now, Steph? Is this what's happening? Is it a control? Are they trying to hold it together still?
It kind of feels like a controlled demolition.
You know, the only reason why the yield curve works right now when they print more money and they do QE is because the dollar still has, its reserve status, and people want dollars. But in the event that people recognize the long-term impacts of reckless money printing, the yields won't be flat. They'll skyrocket. Why? How long can this last with these yields falling because they're printing more money?
Yeah, well, Mr. Market is eventually going to decide how it's going to happen because, like the former Dallas Fed Prez said, we need to get back to the fundamentals. And the fundamentals are going to take place. And that applies to gold, too. It's all tied together, but there's something very interesting that Jim Rickards, he gave a live broadcast last night. I think it's important that everybody know what he was talking about. There's an issue with Saudi Arabia right now with the rial because it's depreciating. And they may depeg the rial from the U.S. dollar. Now, there may be some surprises. It's going to create market turmoil because nobody really thinks it's going to happen. But if it does, we're not probably looking at the dollar going down. We're looking at the dollar going up, but gold going up with it, which happens quite often. So with the interest rates, people are going to be running into bonds and treasuries, and the interest rates are going to go down. So things are going to get really kind of wonky if that happens, and that could be the wrench in the works. But I really, I don't think anybody really knows how, what, who is going to play out. But when it does, we're all going to recognize it for what it is.
TraderStef, thank you so much for coming on the show with me today. I wanted to give you an opportunity to share with us any last final thoughts on what you are advising people on, and just kind of, what is, I want you to share your heart with the seriousness of the situation and what people should be doing at the moment.
Yeah, we're in a recession. At least that's what the data says. Could be going into a depression. Who knows? Maybe we've been in a really slow bleed for 7 years. But with that said, if you're out there purchasing gold and silver, you really can't be looking at the U.S. dollar price because in all the other currencies it's going up. And exactly what I said at the end of the last interview, it's about preserving your capital. Because when you compare what an ounce of gold was worth in U.S. dollars and that ounce of gold, let's just say the 1970s, pull one out of a hat, and what that would buy you, and then what's that $35 per ounce going to buy you now in 2016 versus that ounce of gold? That's what preserving your capital is all about. It's not about the 1 minute daily movement. It's about keeping what you have. And that meme is beginning to leak out into the mainstream financial media.
And that's TraderStef, everybody. If you want to follow her, she has a Twitter account. We'll have the link to that in the video. Her Twitter link is at TraderStef. And TraderStef, thank you again for coming on and sharing your research with us.
Hey, it's a pleasure. Always humbled to come on.